Mr. Dwyer is optimistic, but needs to see market enthusiasm. It's not there. It's an enthusiasm that waits signals from Ms. Yellen and many others. There's no greater signals than that from the Fed. You've seen this before, range-bound churning, waiting and waiting and waiting and waiting. Is it the waiting time? Like, what are we waiting for, September?
There's two reasons in a fundamentally driven bull market, which we explained earlier is based on positive earnings direction, et cetera, et cetera. We're in a fundamentally driven bull market. The last thing you want to do is get really negative. That said, similar to 1997, when you were in a period of a strong dollar, weak emerging markets, lower commodity prices, you actually had a Fed rate hike, and you had one Fed rate hike. Janet Yellen has made it clear, as has the Fed, that they plan to raise rates a couple times. It stuns me that people like me wrote reports about what a couple means. It means two. And then you go into a pause, see what the data says, and go forward. Okay, so our call that's different right now is that we've expected a June to July rate hike for a very clear reason. Any economic data series that I can point to, the unemployment rate, consumer confidence. Are you going to stand by that right now, June to July? I am. Okay, this is an outlier call, folks, from Mr. Dwyer. No, and the reason is because you're already past the point where historically the Fed has raised interest rates by a lot, by a wide margin. You've done the research back in 97, 98. I remember the sweat, that fear on the beach. That fear on the beach in 1998. How are we going to have a mild tantrum when we get that sea change decision by any given central bank? But back when it was Alan Greenspan, there was no... there was a 2.5-month lead-in when you found out what the Fed actually said. There wasn't a press conference, and then in 15 minutes or the next day, you didn't have a Fed governor as the guest host on a financial network. But you're not going to have a gap down 4%, a gap down 6%? I don't believe you will. I think what you'll have... Here's the problem that we have, and the professor and I were talking about this. You have an absolute lack of liquidity in the markets. I woke up and the futures were down 12. 20 minutes later, the futures are up 75 cents. Now they're down 6 and change. There's absolutely no liquidity. Trying to analyze the day-to-day activity in the market is absolutely as insane as trying to trade off the economic data as it comes out, because it is so hugely revised. What you have to look at is the trend of the data and the trend of the market. Both of those are positive with a pause. But at the same time, you're not recommending loading up on U.S. equities right now, Tony, right? Even though, I mean, you said, and I also want to know what... Correct. We're in the 5 to 10% correction camp. We have been for the duration of the year. The vast majority of stocks have actually done that. You have an internally driven, I don't want to say bear market because that's totally inaccurate, but a lot of stocks have already corrected. It tends to show up in the indices last. If you match that 1997 rate hike scenario with the current economic data going around, you'd get about a 10% correction. Then it went 30% higher in the next 7 or 8 months. That's our plan. Your plan is for the U.S. equity market to move 30%? I don't know if it's 30. We're, I think, number 2 on the street for target this year, 23.40 for the S&P, which assumes a 123 in earnings and a 19 multiple. We've been talking data. I want to talk mood. I remember in the 90s there was definitely a sense that this is a bubble. It's going to crash at some point. There was the famous Economist cover that read "Crash, damn it." That doesn't feel like what's going on now. It feels like now the conversation is not when is this going to end, but is this a bubble? Are we even there where we have to crash yet? The last thing I think, Brendan, you ever want to do is when credit is positive, it's a levered economy. When credit is positive, when banks are easing their lending standard, when loan demand is going up, when the millennials are starting to buy houses and the demographic shift is happening, the last thing you want to do is be negative. You just want to pick your spot where to be more aggressive. I want to go academic here. Alvin Roth with us, the laureate from Stanford. I think back to Frank Ramsey, the tragedy of his short life. That was a quieter time. There was less media. Do we have too much media today? Professor, do we have too much information in a Tony Dwyer world?
I think if we don't have too much, information. We do have a data overload. There's a difference between data and information. That's right.
That's the best thing I've ever heard about Tony Dwyer. You can put that on your tombstone. The laureate Roth said, Tony Dwyer, one big data overload. Buddy, I tell you what, I am not. There is such a lack of proper information. I like that. What we do. This is brilliant. This is Tony Dwyer and Alvin Roth. Brilliant today.